What's up, guys? I'm here with my personal friend and bodybuilding legend, Enrique Ceballos, talking about spreads, particularly in
Right.
options with stocks. So, he's wondering, how do I do some of my spreads to collect credit? What happens to some of the legs during expiration? How to manage the risk. So I'm gonna show a brief example of what I've done in the past, what I like doing, and then Enrique, you can let me know your thoughts or what you would do different.
Will do so. Thank
So,
you.
all right, like for example, this may not be one that I do, but just for the sake of the video, right? All right. So this is SPY. It tracks the S&P 500. I look here. I have moving averages. The white line is the 200-day moving average. So I see it. I also have the Bollinger Band and dotted lines. So here it looks like it's already low. It's at a low level. It can continue to go down, but I like where it is here. So what I would do, let's say I'm looking at a week, right? I'm looking to do a weekly spread.
For
So,
example, you have an expiration on Friday, right? This week.
yes. So SPY is nice in that it has multiple expirations during the week. So I could do a Friday. I could also do a Wednesday, right? But for the sake of the example, let's do the Friday, right? So here I see there's strong support around here, right? Let me label that. So I'm going to do my little line. Here I see really strong support, and it's below the Bollinger Band, below the 200-day moving average. So
Where's the
if I'm going to
Bollinger
sell,
Band? I only see the white line, which is a 200-day moving average.
you see the dotted red line?
Oh, yeah. What's
So it's here.
is that
It,
your Bollinger Band for how many days standard deviation?
it's two standard deviations, and it's on the daily chart.
Got it.
Yeah, if you guys want to edit that, you can just go into edit studies, and here you'll see the Bollinger Band.
For 20 days.
Yes, the 20-day moving average is the middle line, and then two standard deviations up and down.
Gotcha.
All right.
And that 427, do you go there and let's say that you like that strike, do you go and check the delta for it? Or do you just assume or take the decision on that strike based on your metrics? Meaning
That's a good question. So actually, I would like both, right? So if I go to trade, I want it to be at or below this 427 line, but I also want to have a low probability. So 427 here is a 4 delta, which is really low. So there may not be much credit here, but just for the argument, I'll do sell. I'll do a vertical spread, right? And I'll get, well, it just went down. You just saw it, $3 for risking 100. That's not a very good trade. So that is one reason why when it comes to this type of spread, I'm not the biggest fan of weeklies because of that, right? Because I would have to be above this level to reach a level of money that I'm comfortable with, right? Because I'm not going to risk $100 to make 3. That's too low. But look at what happens when you go, let's say 30, right? 30 days out. I'll pick this level in March, right? Now my same level of support, 427. Now for 427, I'm going to get, now it's a 22 delta, and now I would get something like 15. So $15 for 100, that's a little bit better, right? So the most I could lose is 85. The other good thing that you'll notice, right? So this is a yearly chart, right? And let me move this left. Extend to the left. So I'm picking this as one support, right? However, I like it because it hit it twice and it came back. It hit it twice again and it came back.
Yep.
But if I were to do the spread 30 days out, if you look at the delta, right, which for you guys that don't know, a delta is the probability of success. So in this case, a 22 delta means that there's only a 22% chance that that the stock will go below 427 30 days from now. So what I would do is just go
at that specific moment, right? It's always constantly moving.
correct.
Yeah.
So what I would do in this particular case, I would even go a little bit lower, right? I like to stay away from, even numbers. So I would pick the 418, 417.
Why is that?
417. And now I'm getting 10.
Why would you stay away for even numbers?
That's just a rule, just my personal preference, because I feel like people like round numbers, right? Like with Tesla, currently 900 is a big number. So I feel like 900, once it hits 900, it's going to move in a certain direction. Like it's not going to stay there. I feel like round numbers are good for support and resistance. So in this case, I would want to stay away from the 420 or the 425, right? I could make it the 424, 423. Right, and that page 13, and that seems like, oh, why would I even bother? But then you could also do,
you're selling the 424, you're
250.
selling the 424 and buying the 423.
Yes, correct. So for one, it doesn't seem like much, but if you do 50 of them, right, you're risking 4,300 and your max gain is 650. So that's pretty good. So one thing that that you were talking about. So let's look at the possible scenarios, right, that can happen with 424, 423. So I'm going to do the same vertical that we were just looking at. This is kind of in the way. Okay. So vertical. Okay. So I'll do 50 so that it's a little more money, right? So I'm gonna go to analyze trade. And now I can see, I'll get rid of my own options so that you guys can see just this. You always want to go to reset parameters and date, because sometimes it can hold on to the information you were looking at before. And then you want to right click here within price slices. It doesn't matter which one. Set slices, break even, and pick the date of expiration, right? So here you see that the chance of success is super high, 99%, according to this, right, as of now. So what happens? So what does this mean, right? So if the price is above 424 at expiration, I get to keep the entire premium, the entire $600. It could go to 620. That's not going to matter. Like my gains are capped by the very nature of a spread, right? My gains are capped. At the same time, my losses are capped, right? So if the Fed has a bad day and Powell decides to screw the economy, even if SPY goes to 0, which would be a catastrophic event, let me just note that, even if that happens, the most I can lose is 4,400, right? The most I can lose, even if it goes bankrupt, that's the most I'm losing. And then there's this in-between spot, right? Like what happens here? What happens here? Anywhere between 425, 424 to 422. That's when there's some variability of, my specific profit to loss ratio shifting. So what I would do, what I like to practice is now at 450, there's quite a bit of range, right? And then the purple line is today. So every day that goes by, the purple line is going to get a little bit closer to the blue line. And depending on where you are with the price, which is this little mustard dot here, it's going to fluctuate, right? So let's say tomorrow, let's say the 10th, the price went down to 430. I'm going to be down $1,000 because I'm not quite at expiration date and it's gone down from where it is today. So I'm closer to losing. And because I haven't met the expiration date, there's that variability. So I'm going to be here. If it goes higher at the same time, like I'm going to be here, right? So if it gets to 470, for example, if it gets to 470, I'm not going to wait till expiration. I'm just going to get out because at 470, I'm so close to max gain that I'm not going to take the chance of what's going to happen in that meantime, you know? Does that make sense?
Right. Yeah.
Yeah. So, yeah, I guess the risk here, right, is once I don't really face the risk, because if I start to get like around, I would look at my chart, right? So this is how I kind of manage it. I would look at my chart here. And right now, this is something I talk in another video, but this is the stochastic. And right now, the stochastic, the trend shows that it's going up. So this is good. This is what I want to see. But if I see that, actually something that I do, I have a flexible grid, right? And it looks like this. So here I can see the stochastic both on the daily and the weekly. So on the daily, it's going up, but on the weekly, it's going down, right? So once I see on the weekly that it reaches this lower blue line, I would say that it's oversold.
Oh,
And this would be a good time to take the strategy that's a few weeks out, right? But keep in mind that the daily precedes the weekly. So whatever happens on the daily, it's going to start to influence the weekly eventually. So because I'm seeing this large uptrend on the daily, I expect this to turn. But just for confidence, I would like it to be a little bit lower. So now let me go back to the chart. All right. So with that said, right?
so that weekly and daily is the stochastic?
Yes, that's what I was just showing you. So for example, let me go back to the chart. So if I'm here, right, and I see that the trend is going up, and then I see, as long, like there's a saying, the trend is your friend. So as long as I see the trend going up, I don't really care where this is going, as long as it's not like really close to 424, right? But if we're around 430 and I see this trend going down, then I'm going to exit. So if I see the trend changing on me and the price going down, that combination, I'm going to exit regardless of where it is here, right? So that's one thing to keep in mind. So I don't really manage like, I'm at a 425, I expire in a few days, like what am I going to do? I don't really worry about that, because by the time it gets close to that, I'm already out. And I rather take the small loss, which would be around here, right? A little over 1,000, than to eat this huge, 4,400. Does that make sense?
Yeah. Yeah.
Yes. So one thing that you did before, and I actually wasn't that familiar with it then, is you did something really cool, which I've been using more and more now. I like it more for something like, actually it would work here, SPY, okay. A back ratio, right? And it works kind of like this. So let's say in 30 days, right? I'm going to sell 2 calls. I'm going to look again here at my chart. And if I look at my chart, I feel pretty confident that the price, there's 1, 2, 3, 4 moving averages. I like that my chances that in a month, we're not going to hit 470. So I'm going to go to 470. It has a delta of 17. I would even go to 472 because I just told you I don't like those numbers, right? So I'm going to go here. I'm going to do 2 of them. And then I'm going to buy a call in front of it. This is called a back ratio. And I'm going to buy a call at, let's say, 458. 458. Yes, this is what I want. Okay.
One?
Yes, 1. So then this is nice, right? Because, or I could do it this way so that it pays for it. And I'm just going to play with the numbers a little bit so that they make a little more sense. 460.
You are selling a call and you're buying a call slightly
Do it this way for 60.
lower.
And I'm going to show you why in just a second. Let me just go to,
Lower is more expensive, of course.
yes. Okay. All right. Let's do this example. All right. And this is why I like it. So I'm selling 2 calls at 472, and I'm buying 1 call at 466. And look at what that looks like. Okay. Again, I'm going to reset everything. Set slices, break even. Okay.
How do you read that?
No, too far. Okay. Maybe still a little too. There we go. Okay. So look at why this is so nice, right? So basically, the call bought itself for free, right? Because I'm paying for this, the price of the call with the premium that I received from the calls that I sold, right? So then the worst case scenario, the worst thing that can happen here is that the price is going to go to 0, right? So on the downside, I'm completely covered because of the calls that I sold. So even if it goes to 0, I'm going to collect $13, no matter what. If it tanks, if the Fed has a bad day, a bad year, I'm going to collect $13. But on the bright side, right, the price is currently here at 450, and I have a call at 466. So, and I'm selling 2 calls at 472. So at 472, right, as long as the price doesn't go above 472, I'm going to collect the premium. However, as it starts going up, which is typically bad when you're selling the call, right, because then I'm getting closer and closer to being assigned.
Yeah.
As it starts going up, right, and you could see that more here. There we go. Now I got it a little more like what I wanted. There you go. As it starts going up, I'm going to, my 466 call is going to be in the money. And what that means is that I'm going to be collecting that money, right, from that call before I start to lose money on the calls that I sold. So as long as I don't beat 472, it can go as high as it wants, and I'll be making money, right? Which is really nice. So then what will typically happen, right, is we'll reach 467, 468, 470, and at 470 I'll leave for a profit of 300. No more, sorry, for a profit of 412, 408, depending on the day. Like right now, it would be negative, right, if it goes up. But just look at what happens when the day starts to get closer and closer and closer and closer. So somewhere about the week before, I would look to exit, and that's when I would be making. I probably won't make the full amount, right, the 611, but for $300, when I was on the downside going to make 13, it seems like a really sweet deal. So it's almost like, your worst case scenario is that it goes above 472. But if that happens, right, you're going to be making money in the process.
What's your max loss there?
My max loss, I actually, doing this strategy, I never achieved it, because by the time I see we're around 460, 470, I'll exit before I reach 472. But to answer your question, I mean, if it goes to like infinity, 500 and let's say 520, I can lose for a little more, 4,200. But that would be extremely unlikely, right? Like if you look at the probability,
Yeah.
The chances of it hitting 500 are basically nil, right? Based on this chart. So I like doing this a lot because.
And when do you start losing? Can you show me again? What's the point where you start losing money versus when you start
478.
478.
So anything, and also this gives me some range, right, on my call. So anything below 478, I'm making money. And so I know you like probabilities, right? So if you look at the probability of 478, the delta, 1 minus 97 right now is 0.03. So the chances of me making at least, where was it, $13 are pretty high because I'm completely protected on the downside.
Yeah, if it falls to, let's say, 450, what happens?
Oh, it doesn't matter. Like no matter how low SPY goes, I will still be making $13.
Because you're selling the call because of your sold leg.
Exactly, because the calls that I sold are protecting me. Exactly.
And what happens to the 466 leg though?
Well, the 466 will just expire worthless. And I could show you.
No, because you're buying it. It doesn't expire worthless, right? So let's say that it falls to 450.
Right.
Shouldn't you start losing money on that leg?
Well, yes, but I'm being protected. You know what I'll do? I'll do them separately so you could see them one by one.
Okay.
And see how they impact the I'll do this. I'll do, let's see, I'll do four. Do you remember which ones I had? It was 475, right? I had one here. One here. Okay, analyze that. Okay, now I want to go back here. Delete that, and I want to show. Okay, now I have them separately, right? Okay, perfect. This is what I want. Okay, so I'm going to reset parameters and date. Set slices, break even, boom. Okay, so this is not exactly what I had before.
It was 466 and 472.
472.
Okay.
Yeah, that makes
or 470. Was it 472 or 470?
Okay. All right, let's, you know what, let's do 470. Okay.
Yeah, wait, actually.
Perfect. And now
it was 466 and 472.
Okay. Okay. So here I'm making $8. Okay. And then here it starts to go down. Okay. So to answer your question, right? So when you buy a call, you're very bullish on that particular stock, right? You think that it's going to go up like this.
Yeah.
So if I don't sell any calls and I just buy a call, it's going to go up exponentially, right?
Yeah.
So what you want to do in that case, right, is if you look here, the benefit of buying a call is that if it starts to go down, like my loss is capped at whatever the price of the call was, right? So when you said it's going to go to 250, it's not going to expire worthless, but it wouldn't make sense for someone to exercise it when it's not in the money.
Right.
So basically, like if I, let's pretend I don't sell any calls and I'm just buying this 466 call.
Yeah.
I need to hit at least, and it'll show you here, I need to hit at least 468 just to break even.
Right.
Right. So if that doesn't happen, anything below that is a loss. So to your point, if it hits 450, it's minus 27. I'm eating the price of the call. If it hits
Exactly.
430, minus 271. I'm eating the price of the call. No matter how low it goes, anything below 468, it's considered a loss. So that's where, and then this selling of the calls works the opposite way. You would do that when you're short, when you're bearish on it, right? So this would work. Anything below 472, I'm making money. Anything below that, I start to lose money, only because what happens, right? If I don't own the stock, at the time of expiration, whoever owns the calls is going to say, hey, I want to buy these shares from you. at $472. But what if the price is at 500, right? I'm going to have to go into the market, buy them at 500 and sell them to this person at 472. And that's the loss. That's why it keeps going down, right? The higher it goes, the more I will lose. So that's why this is kind of nice, like combining the two. Because if I combine the two, then no matter how low it goes, I'm not going to lose any money because the loss of the long call is more than offset by the premiums of the short call. And then the same thing on the upside, right? Like while my gains are capped, I still have more up room on the call, on the short side of the calls than I would have without the call.
So the selling of it's the gains of the leg that you're selling that offsets the loss of the purchase.
Right, exactly. So this is really nice because it can kind of protect you on the downside, right? So of all the scenarios that can happen, if it goes down, I win. If it stays the same, I win. If it goes down a little bit, if it goes up, excuse me, if it goes up a little bit or a lot, actually, in this case, it has to go from 450 to 470, I win. It's only if it goes up an incredible amount that I lose. But in that case, like I have to, like if you look at the diagram, I have to pass my maximum point before I lose. So once I see the price start to go in this direction would be when I would take action.
Okay.
Yeah, and that's how lately this is how I like to play spreads. They're a little more margin intensive, but I feel like your probability of success are way higher. And to answer one thing on spreads in particular, right? Lately I like longer expirations only because they give the stock more room to run. I feel like if you stay to just a week, right? If you stay to just a week or 3 days, like it's a 20 delta is going to be really tight. It's
Very tight.
439,
It's too
which is
high.
not,
It's too much of a risk.
yeah, 439 is still way above this 427. So it doesn't have enough room. And I feel that's what has burnt me in the past, right? Like not having room for it to run, just a little bit of room, a little bit of a downshift, and then I'm losing money. So yeah. And then another thing, people talk about managing your position. It's a lot easier to manage one, like if I just one leg versus two. So if I'm short, let's say I sell a put, it's easier to roll over one put than it is to roll over one spread.
Yeah, of course.
Yeah. So that's also one thing to think about. So yeah, that's kind of,
But
you
you're
have
not
the,
gonna, but you're not gonna be creating only a one-legged put, right? That you're selling. That's too risky.
see, it is and it's not, right? And I'll show you why. So one thing that's pretty cool, and I could show you with one that I own, is with Facebook. All right, so April 22nd, a few weeks ago, when Facebook was around 330, I decided that I was going to sell the 290 put, right? Which means that if Facebook
It's below
goes,
290.
I'm, excuse me, obligated at buying it at 290.
Yeah.
Anything above that, I would make money, and it's gone down since. So what does that mean, right? So that means that, actually, I could probably show you here. Yeah, here we go. Okay. Let me reset the parameters again. Okay. So this is where we are, right? Anything below here start to lose money exponentially. But here's the beautiful thing. I could roll it over. And that's what I mean by managing, right? I could roll it even now that I'm slightly negative, right? I could roll it over for a credit. So for 290, May 22nd, I'm making 405. And if I want to be more conservative, right? If I'm like 290 is a little too close, I could bring it down to 280. It doesn't have 285, 280, still make money. And now I'm lower. I would be buying, my strike price is lower. So I feel this particular step of
When you
rolling
roll
over,
over, what you're doing is basically just buy it back and then sell another one, right?
yeah, exactly. But at a profit.
Yeah.
Yeah, that's key, you know. Whenever I've tried to do this with a vertical spread or with a spread, it's usually losing money. So that's why I like just doing one, because you're right, you know, it's very risky. I can lose tens of thousands, but I feel like it's easier to manage. And in this particular example, what I always tell people is don't do this unless it's a stock that you would be comfortable owning. And for me, Facebook is that stock, right? Buying it at 290, I'd be very happy doing it. But buying it at 280, I would be even happier because I know that long term, it's only going to go up. And if you want to be a little more conservative, right? One that I tell people like to start out with would be Apple. I don't happen to own Apple, but Apple is, you know, April. I'm looking at the option chain now. If you look at April, 150, right? You would make $223 and you would buy Apple at 150. The chances that it's going to get here are really low, but Apple, because of its volume, because of its name, it's really easy to roll over. And if you do this monthly, you're generating, you know, easy income, easy 200, 500, depending on how many you have, right? But if you have at least $15,000, well, you know, in the worst case scenario, you're able to buy 100 shares of Apple. I would say this is a really safe play to generate monthly income.
Beautiful. That's a good advice. All
One
right.
thing to know is that the higher volatility of the stock, the more money you'll get from selling puts, right? So Apple is pretty safe, so it doesn't pay that much. But one thing that I used to do, and I remember talking to you about it, look at Tesla, right? Tesla, you could actually do it weekly, right? Let's say I'm a huge Tesla fan and I say I'll buy Tesla anytime it goes below 900. So if it hits 890 and I'm happy buying it, right? I'll buy it at 890, but in the process, I can collect $2,300 by selling a put, right? It's this is an example for people to have a little more funds, right? But if it's
as
stock
long as
that
there is you don't want to risk more than you have what you have.
Of course,
If you're dealing with margin, that's when you can just be
right. Assuming
with the water
that
above
you, yeah, assuming that you have the funds to do this, if it's a stock that you want anyway, sell puts, because if the price doesn't get there, you're going to be collecting $2,300 each time. And if it does, it's a stock that you want anyway, right? But Tesla's an extreme example. I would say even Intel, right? Even Intel, like if you do the same thing with Intel, right? You could collect $50 a week, every week, you know? It's pretty nice. So
it's the other way around as well, right? If you want to sell stock that you have, you might as well sell a call.
yes, and that's something known as the wheel strategy, right? So if I have 100 shares of Intel, let's say I bought them, I buy them now at 48, right? I would go a month out, sell the let's say 51, right? Since you like probabilities, I between the 30 and the 20 is what, you know, most experts advise. So let's say you want to be a little more aggressive, you go with 28. You'll sell the
You mean for
covered
actually
call.
selling it, for actually
Well, if you own 100 shares, this is known as a covered call, right? So then I'm collecting the $69 premium. And then if the price goes above that, then I'm simply selling it, selling my shares at that price.
Yeah, you're happy to sell it at that price.
Yeah, I'm happy to, it's above what I bought it for anyway. So just let it work in your favor, right?
Right.
And then something nice, like, you know, if you feel like that it will go up, you can you can buy a call, let's say here at 49, right? And then it's costing me $71, but it's, you know, it's offset in the price of my call. So that's the magic of spreads.
Okay, man, that's clear. Thank you for your advice.
No problem, no problem. And thanks for joining. And you know, I'll see you guys in the next video.
Awesome.
All
Thanks,
right, take it
everyone.
easy. See ya. Bye.